Hi, this is Randy Finney with the Right Side of the Chart, and this is a mid-session update for Wednesday, September 16th, 2020. What we'll do is stick with the equity markets. We're going to look at QQQ on various time frames, both near term as well as long term. Every now and then I like to loop back to the long term charts, paint the bigger picture, and I also would like to go through just the a few of the top holdings in the Nasdaq 100, the market leading FAANG stocks, because they are the market, make no mistake about it. They have such a heavy weighting on both the S&P 500 and particularly the Nasdaq 100, and that's been driving the whole, just about the entire rally off the March lows after the COVID drop. So let's talk about near-term and short-term stuff. All right, I'm going to kind of start here in the middle on the daily chart, and we'll loop around. I'll tell you what time frame we're on. But most important thing is we've broken the trend lines. We had trend lines that have been waiting to break since back in late June or early July right here, and they've held, and those support levels we just continue to move up. So again, we've had the first sell signals on the daily chart in a long time. We also had call it pre or early sell signals here right there, and that's where we identified on the 60-minute chart as well as the daily chart here. You had that subtrend line, and so that's what gave us our sell signals before, and that was very early on in that 11% drop in QQQ. So where do we go from here? All right, let's loop to the 60-minute time frame. Before we do, let me just say that we are still below that trend line, so that's something to note. We're below the trend line there. However, daily indicators, the trend indicators haven't rolled over. We have a sell signal, but one of the trend indicators I like to use on many different time frames, including the daily, is this PPO signal line, and it just does just such a good job at defining bullish and bearish trends. It's unlike, just like any indicator, it's not perfect, but when you cross below, and I'm talking the white line, the trend is bearish, and you get out of your longs, go short, and it tells you you're in a bearish trend until we cross back above there, and then you go long. And so you can see we're solidly in that one trend indicator in a bullish trend. The problem with using trend indicators, especially when you go out in longer time frames, by the time they roll over, there can already be a substantial correction, and the trend reversals times well into underway, I should say, especially when you get to extreme levels and you're very high like this. It's going to take a little while if and when that white line crosses down below there. But again, you can see pretty good job. And that's not even a whipsaw. That was all bullish. The white line above there, tiny little whipsaw there, but a little bearish crossover, and it caught that. It caught that drop. That was a pretty big correction right there. All right, so let's look now to the 60-minute chart, and then we'll jump out to the weekly chart. 60-minute chart, same thing. I'm zoomed in a little bit here. Zoomed in to show you that's that same trend line on the daily chart. There's a breakdown. Just to kind of recap, laid out 4 targets initially with a sell signal come on a break of this minor trend line here. So we got that breakdown right there, and that was a golden entry to catch most of that 11% drop, almost perfectly hitting 4th and final target before reversing. I did add after we started falling upon the request of someone. I said I think we good chance we're going to hit it, and I still do. A potential 5th target down here, but at this point, we had bullish divergence, as pointed out. We even had bullish divergence there on the futures, but then we had it here on the index ETFs. And so it's accounted for, at least it was the technical catalyst for this. Well, a few things were the technical catalyst. Number one, drop to 11% drop to a major, pretty well-defined support level. It's not just a random level. There's gaps and reactions and things to the left of the chart on there. So you had that. You were oversold. You had bullish divergences, and then your buy signal came. Although that when you can. It's always an objective long to go long on support, game a bounce off the support level. We also had a buy signal there. So there are mixed technicals. I made the case, and I'll still say it's certainly a possibility. Things can go either way here, that we go on up and hit this, what initially was my, I had a max bounce target range, is what I like to call it, and that's still what that is 286.32 and the 50% fib up to this former T1 zone, which is 291. We'll call it 292. Let's just keep it simple. 292, as well as the 61.8 Fibonacci retracement. And see, they all come in perfectly. That 61.8 fib, this uptrend line, and to try to quantify it, if and when we get there, it would be from where we're at right now, just assuming that we turned around, went up, about another 5%. Does that mean that's all we can go if we get there? Absolutely not. And like I said, I think if we take that level out much, regain that trend line, take out this resistance zone, most likely going to open the door to new highs. Okay, so on the flip side, what if we don't get there? What are we looking at? Well, as I said, it's going to be a choppy trade. If you're an active trader, great. You can game the little micro rips and dips. And if you're not an active trader, if you're a typical swing trader, part-time trader, you need to kind of tune out the short-term zigs and zags, and then the same way an active trader will trade is you need to add and deduct your positions, meaning open and close, or add in, scale out. You need to do that strategically, or more, active traders do it more tactically. And so what I'm talking about here is this recent trading range. We have the double bottom in the futures. That's what I jumped over to, guys. Sorry if I didn't mention that. NQ Nasdaq 100 futures 60-minute chart. There's the same primary uptrend line broken. I had to, these are the Decembers. At some point recently they rolled this, so sometimes these price levels will change when this charting platform rolls from the previous, I think the September contracts to the December is now the continuous contract there. So that's it. This is kind of near-term picture. Multiple reactions here at the top of the zone. 2 at the bottom so far, and whether or not we take out the top of the zone, like I said, we take it out impulsively, that will most likely open the door for a move up to that potential target zone up there, right here. And as I said this morning, this is an objective, because that may not happen, and I'm going to get to reasons why here in a second. So as I said this morning, that's an objective short level, especially for active traders. And the thing about it is you can do it one of 2 ways. This is what I tried to convey on that post this morning. There's either a hard short, a 1 entry, whatever your position size is there that you want to take. You short at or near that top of the range with a stop somewhat below it. I'm sorry, somewhat above it. What is somewhat? Well, somewhat varies on you. If you're going to swing for, let's say, a move down here, then calculate that drop and use an attractive risk-reward ratio. I like to use 3 to 1 or better, somewhere in those lines. So whatever that move is in percentage terms, divide it by 3 and then add that there, and there's your stop. You may just be looking for a quick reaction off there, something like this. And if that's the case, you're going to have a tighter stop. Now on the other side, and this is more to the swing trader, and again, assuming you're taking the view this is a counter trend bounce. I also addressed for those that are long and bullish looking for new highs, that's a good time to trail up your stop and let your position run, or raise your stops at this point. So finally, for those swing traders that might be looking for this and ultimately a break of that lows and then a move down to that 5th target zone on QQQ I talked about, wherever that is on here, you can add here strategically, and you can continue to scale in if and as we go up to this point, but not above it. In other words, you don't want to dig yourself in a bottomless hole. There's nothing wrong if you're saying, well, you know what, I'm with Randy. I think we can go anywhere from about here all the way up to here. Anything much above that, it means it's probably the correction is over and we're going to new highs. And in that case, you want to stop right here. And then you scale in. You maybe do, again, you might have already done it here. You might have done it here. Those were objective, shorting entries before. You do some here. And by this point, you'll be up to a full short position, or maybe even a fractional, and you want to wait for the reversal. So there's a lot of ways. Many ways to skin a cat is the expression. Many ways to trade. Scaling in is pretty good for less active traders, because you average in, and now you may never get up there. So what do you do if you added a short here and here? You've been shorting up to here and you plan to add some more. Well, if you break the bottom of the support zone, you can add more there. There are traders that will not scale or average down on a position. Typically professionals do that. They'll take a position, and some will only add to the position if and as the security confirms their initial thoughts on where it's going is correct. In other words, short here, don't scale, don't average down. That's typically the retail trader likes to average down. I'm lowering my cost basis. Well, again, I'll do it if that is my predetermined plan, but I will not do it for the sake of trying to lower cost basis on a losing position, because it's telling me, if I thought this was a maximum bounce point for NQ and QQQ, and it's doing this and then this, then I'm wrong. But if it's doing this, I'm right. So you can average in, and especially, again, as I've said, I think if we take out these lows, it's going to be a pretty quick, waterfall type sell-off. This is a waterfall type sell-off. This is what I'm talking about, impulsive selling. So that's where I'm at. I'm leaning towards that, and at this point, I did mention the other day when we broke above here, that was near-term bullish. It certainly was. And there was more upside from there, so that held correct. That was a buy signal, break out of the bullish falling wedge. From there, we went up, whatever it is in percentage terms. And in yesterday's video, I highlighted a trend line here, which later that afternoon, under that post for that video, I posted an updated chart. It broke down, so there was a sell signal there. And so far, QQQ has been moving lower, and it's also starting to take out the recent trading range it's been in the last couple days. You can see right about here, it's been trading, and now we're moving lower. There is a gap to be backfilled, so maybe QQ wants to fill that gap. If it does, there's another gap right there to be backfilled. These are the potential support levels on the way down for active traders. But again, if you're swinging and looking for the bigger move, then if you shorted here or you short right now, whatever, you can have a stop somewhat above here or no more than all the way up here. And if you're bullish and long looking for new highs, just that all depends on your entry points. And that's one thing I do here. Whether I'm bullish or bearish on any security, I'm going to identify levels, and I'll give you my my preferred scenario, and I'll give you my convictions, how strong they are, how whether they're not that strong. But I'll identify these levels, and you can use these same levels. A bull could, like I said, if I thought the market was going to new highs, the Nasdaq 100, and I'm certainly open to the possibility, but like I said, and I've said it many times recently, this is the best long setup I've seen in a long time. Bullish divergence on the 60-minute charts across the board on all the ETFs, index tracking ETFs, SPY, IWM, QQQ, and also on the FAANG stocks, which I'm about to get to here in a second. All right, so that's near-term stuff. PPO's crossed back above this purple line, about the negative 0.49, but it's right at the zero line. Sometimes the zero line is what defines the trends. You can see reactions on the zero line here. And if you go back in time, you can see some other reactions on the zero line here, where it bounced off that. So that's really what I would call, a resistance, support resistance zone, that zero line down to about 0.49. So it would be optimal. That's not everything. It's not the be all end all, but it is a trend indicator I'm watching. So if we go up much more, we're going to break through there. But this indicator, like all, is prone to whipsaw signals, but I'll have to recognize that for what it is. If we go up much more, we're going to have taken back the zero line on PPO 90 MA, the signal line, on the 60-minute chart, that is. Okay, that was all very short-term stuff. That's what the active traders are watching. Maybe even less active traders are just looking to strategically add or, again, subtract positioning. Maybe you're subtracting is closing out, scaling out of a long you traded on the bounce. Here's the bigger picture, and what we're going to do, let me just park some, well, no, let me leave that one there, and I'm going to point out just a few things down below. So I have these indicators expanded, and what you have down here is a PPO. It's very similar to MACD, close cousin. If you don't have a PPO on your charting platform, you can use the MACD. You'll see something very similar. This just does a better job on especially on long-term charts, and securities with big price moves. All right. What stands out to me is a pending and almost imminent, nothing's guaranteed, but it looks like a PPO crossover is imminent at this point, because the PPO, which is a momentum indicator, remember, everything is about momentum. This has been one of the strongest momentum rallies that we've had in a long time. Fed had just juiced the markets, juiced sentiment by pretty much convincing the masses that they're omnipotent and in all control and will not let the market go down, that they have the power to do so. We can debate that all day long. I don't believe in that, but I believe it affects psychology of investors in the marketplace that believe that the Fed is all powerful and can keep the market up despite whatever happens with the economy. So let's just get off that. That's just my view, but I believe that's what's happened there. Now, whether or not you think that has anything to do with it, whether you think it's a strong economic recovery, whatever your thoughts are, it is hard to argue this was a momentum, or what I call Momo rally. It's a straight unidirectional, hardly, the corrections along the way were very small. And so what I've been waiting for a very long time is to see that momentum break. That's what usually happens. Some stocks can go up well beyond, or the market can, well beyond where people think they can. They become more overbought, and you get the greater fool theory kicking in. People are just buying because prices are going up, thinking they can always sell to a greater fool. There's always a greater fool out there that will buy their shares. But once a momentum breaks, and again, that's what these trend indicators are telling us, when the momentum has turned, the ship goes the other way. Things can turn very quickly, and that's usually what happens when stocks drop. All right, my explanation of how and why those things work. Now let's just look at the facts here. So I'm going to grab this little tool here. Let me go to a circle tool and color that up here, the right color. Okay, so what we're looking at first, it's the PPO. Again, it's a momentum indicator, and what is it telling us? Well, it was going straight up, saying the momentum was up, was bullish. There was no arguing that. It was not debatable. And now it has turned. It peaked at this point, and it's headed down. It's headed down pretty sharply, and it hasn't done so yet, but it's poised to make a bearish crossover. Here was a strong momentum run up to the pre-COVID highs back in late February, I think it was, and there's your bearish PPO crossover. I avoid momentum indicators or trend indicators when things are whippy, but you can if you want to look at each and every signal, you can go up there and you can see that when it did cross, it did signal corrections. These don't look like a lot, but they were probably 5 to 7, maybe even 10% or more, those two corrections that it did signal. So I'm going back and I'm circling each one without fail and showing you. Here, I'll measure this one out. From top to bottom, when you got that one there, it was about a 23% drop. Okay, that was the Q4 drop. All right, so these are the facts. These are unarguable, and these are things that go into my analysis. This is what technical analysis is all about at the core. It's studying a chart, identifying past market conditions, past similar technicals, things in the charts, to predict where stock prices are likely going. So we have a 23% drop. That was a big Q4 drop. Doesn't look like much. I'm going to squish prices here, and I'm on log scaling. There was a drop. Again, these were all significant corrections. This was that COVID drop right there into the March lows, and without fail. So every single bearish crossover on the PPO, especially when you have some clean separation like this and these runaway trends, these give you the big ones here, they signaled corrections. You can go back and see another one here, and there is a correction there. So okay, that's that. Now the histogram also helps you get a visual representation of when the two lines cross, because when it's green, the higher these bars are, the higher the differential, the greater the differential between the two lines, meaning the PPO line is above the signal line. And so again, do we have to make a bearish crossover? No. Sometimes it looks like it's imminent and the lines bounce, but when you have an extreme overbought condition like the PPO is up in nosebleed territories, it's highly likely. And by the way, guys, what I'm speaking to now, just to be very clear, is trend stuff, swing trader stuff, not the very active trader stuff. So again, we want to measure it out here, go back in time. The last time we had a bearish crossover on the PPO, the market fell 30.5% right there. You can see on the measuring tool in the pop-up box to the left. So and that was the QQQs. So again, you decide how you want to trade it. I'm pointing out the facts. And the other things I want to talk about are overbought conditions right here on the RSI. But I think to do that, I'd rather go over and roll into the FAANGs now. So we're on QQQ. And as I said, it's been all about all about the market leading FAANG stocks. So we're going to look at those because of the weighting. As I mentioned the other day, just the top 3 components of the Nasdaq 100 alone, Apple, Microsoft, and Amazon, account for over a third, over 1/3 of the performance. That's how heavily weighted they are because of their huge market caps. It's a cap-weighted index. Apple's a $2.1 trillion company. Amazon and Microsoft are $1.6 trillion companies. So they have a ginormous impact on the market. So let's just quickly glance their technicals. Apple. PPO has clearly rolled over. The momentum has shifted. It hasn't made a bearish crossover, but the last time it did was right here. You flattened out there. It bounced. There was a few cases it looked like it was poised, but it held. It bounced. If there was a crossover, I zoomed in. Maybe you can caught that little one there, and there was a pretty clean crossover right there. So you can do the math and decide if you want to buy Apple, as an investment, if you think there's a lot more upside after that crossover. Now I'm going to turn on all the lines that I have here on the charts, and what I'm going to do is we can look at the PPO, but I'm going to park it for now, and we're going to just study the RSI. The RSI, relative strength indicator, is a commonly used indicator to measure how overbought or oversold a stock is. The default settings on most charting programs are going to be 70. Anything 70 or above is considered overbought, and 30 is oversold. However, 70 doesn't work with Apple. Apple's a crowd favorite. They buy it and they keep buying it and they love it, and it gets ahead of itself, and then it has corrections. I've measured out all those corrections on this chart: 39%, 34%, 45, 16, 15, 26, and so forth and so on. And so what we have in common, and I'm rolling back here decades. Here's the dot-com bubble. This is the year 2000 right here, and these are the 90s. And so what you can see here is I have a line. Just because Apple gets a 70, you want to short Apple in a bull market, when it hits that oversold reading, you're probably going to be killed. You're going to lose a lot of money. It tends to keep on going on past through there. So again, I redefine, or my definition of overbought on Apple is about 83. That's where I have this yellow line right here, right? Okay, so that's, or what I call, let's just say, the extreme overbought reading. Again, because we're going back decades here, and you've only seen that level, a handful of times here. And so what happens is it's usually not the initial tag of that level. You usually get a correction at that level. Sometimes it's one and done, but most often you put in a divergent high. In other words, we're just going to start here. I'm going to follow there up. So we hit the extreme level about right here, right? But the stock kept going, and this is 2000. Remember, this was the dot-com bubble right before it burst. And what happened is Apple kept going up, but yet the RSI was going down. It made a lower low. That is negative divergence. These are the divergence lines I put on my charts. It's a big part of my trading. And again, it speaks to momentum. When you have divergence, price is going up, but the momentum indicators are going down. That shows you the momentum is waning under the hood. You can't see it just looking at price, but that's what it's telling us here. And so if I want to measure that one out, which I didn't do, that drop, before all is said and done, had you not heated that, let me turn off everything here, the drawings. I'm just going to measure out, if you either got out of Apple or shorted it based on, that divergence right there, that second tap. If you were long, let's just start there, because I know the majority of people listening to my voice aren't big fans of shorting stocks. I happen to be. So that's why you have a lot of short setups and bearish analysis on the site, but as you know, I'm equally happy, going long things. So that was an 85% drop over 3.5 years. You would have sidestepped that if you were long, and you would have seen at the bottom, you would have had bullish divergence. I don't have it drawn here. There were buy signals all across the board there to get back into Apple, but I just want to point out that you sidestepped an 85% loss. I mean, put that stuff in dollar terms. If you had 100 grand in Apple, guess what? You were down to 15,000 back then if you weren't shaken out by then, and you probably would have been shaken out somewhere along here, and then watched it do this and chased it here. That's the typical pattern of the retail investor. Okay, so let's just look at the facts and we'll move a little faster because there's other stocks. So again, it's usually not that initial tag, but you have stock will go up for several more months and then put in a lower high on the RSI, the negative divergence, and that typically marks the top. There's your divergence right there, overbought. There's your divergence line. There's your correction. I didn't measure that one out, but I can tell you each and every one of these corrections, when you're using these weekly divergences, measure well into the double digits. In fact, let me try to get this one for you here. That was a big one there. That drop was roughly 52%. So the stock got chopped in half, and these are the common similarities. There's your divergence. You hit the extreme level right there. You hit the yellow line. Made a lower low on the RSI, and you continued higher, and the divergence extended. It got even a little more steep right there, the slope of the divergence, and then boom, that 55% drop. And it ended with, you got it, divergent low. So it's not, I don't just use these divergences for, short setups, bear setups. The same things work in reverse to go long after a correction or a bear market. You can see here. So we're going to move on. You can freeze the video, study the chart, look at the divergences when they started. So this was a series of divergent highs, and it's not as if they weren't playing out. They were. 26% drop, 15%, 16, and then finally after, well, this was a new one. It kind of reset right there. There's our tag again, our first tag in a while of that yellow line. There's your divergence. And what I wanted to do too is measure this out for you and tell you that usually takes, the measuring tool on the left will tell you right there, that's 5.6 months from this one here. We almost hit the yellow line, close enough. I'm going to just use this one to give you the time frame. That was about 5.8 months. Here it took a while. This one was a year, 1.3 years. So it varies, but it's usually at least a good 5 months or so after the initial tag of the yellow line. You can see here we didn't just tag it, we greatly exceeded it. And so from there to where we're at now, we have another tag of it, and it's been 7.6 months. So we're at that point where Apple may have seen a significant top, and I'm favoring that just based on the average there. However, there are some periods where you get corrections along the way and you continue up. So at best case scenario, that's not my preferred scenario. Maybe another thrust up to extend these divergences, and then the big double digit drop, 30 to 50%, which is the norm in Apple with these big corrections. All right, so that's that. I just wanted to point out where we're at, and we just kissed that level again. I am going to do something I shouldn't. I want to stay on track. I'm going to hit the other things, but I forgot I wanted to cover this real quick. Something else going into my analysis lately, and I've covered this quite extensively leading up to before we had the top in the market recently, was this. I started really harping on these put to call ratios, the CPC, which is a total put call ratio, as well as the CPCE. It's up here. This is the equity only put to call ratio, and without fail, it hit my extreme bullish, my sell signal line, which without fail for the past decade has been followed by. It hasn't identified each and every big drop, but when we hit that level, there has not been a whipsaw. And this, as I said, it's not a failed signal. It's a cluster. And when you have these readings, sometimes they're one and done. Sometimes you have this, I think was a double tap here, double tap, and this was a quadruple or four tap. We had multiple readings in close proximity. And so this tells me that without a doubt, sentiment has just gone, recently it reached extreme bullishness. Again, evidenced by what I said, what I believe to be a false belief that the Fed can, indefinitely prop the market up. Whether or not they can, this indicates a correction's coming. And then what happened, as I talked about, every other time we had those corrections, fear came back into the market. Probably have the wrong color here. Let me color this up. Fear came back into the market, and you saw the put to call ratio spike after the reading and after the correction, and that kind of alleviated, reset that, put some fear back into the market. We hit it there. We had a big correction. Took a while. You can see the scale. And here's the year break lines down here. But you can see ultimately that correction ended with fear. This one, you hit it and you had a quick correction in the market. A lot of people turned around after buying nothing but calls. They started buying a lot of puts. I shouldn't be literal. It's not nothing but much more call buying here, thinking things are going to continue to go up forever. And they bought a lot of puts. And by buying those puts, it puts a floor in the market. That's protection. And that's usually what ends these corrections there. So you can see this time around it's different. We've had the most persistent cluster, not just one, but multiple readings in very close proximity in recent months. And this is all we got out of it. So what I see is no fear. There are a lot of, this tells me that the majority of market participants believe the market's going much higher, that this is a buying opportunity, and there's no reason to fear that we're going to have another big drop in the market, anything close to what we had in the fourth quarter of 2018 or, into the March lows of COVID. So again, I wanted to loop back to that because I did not want to forget this chart. All right, to wrap it up, we'll go to the other FAANGs and just look at their RSIs on the weekly chart. Again, that's what I was studying on Apple a minute ago. I'll go through it a little quicker on the rest. Amazon, I didn't have it all. I'll add the line there. There's your divergence. There's your hit. You hit the purple level, the extreme. There was an initial drop, but you went in, you put the divergent high. There's your divergence line. You made a higher high in Amazon, and that was it. And from there, Amazon fell 90, almost got wiped out. I mean, look at that drop in percentage terms, 95%. I'm going to draw the divergence lines out. This should have been on there. That's what it looked like. Boom, 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 like that. Okay, and even this one there, that was well into the double. That was probably 20-30% or more right there. Big drop. Boom, we hit it right there. This was a one and done in Amazon. So like I said, usually you get the divergence, but this was a one and done tag of that level right there, and followed by a multi-year drop. These are the year break lines of 35%. There was a hit, and you got your marginal new high. Amazon kept going up, creating the negative divergence. 66% drop. Negative divergence, 30% drop. That was divergence, but we didn't hit the purple line there. We came almost right up to it, close enough. I could pull it a hair lower. 32% drop. We hit it here and here. I gotta zoom in now. Had sell signals back here. These are all my notes from before when we were down 31%. I had a target down here. I said more to come. Yes, it was 36% drop after that double tap there. And then right here, this is where we're at right now on Amazon. We hit the purple line right there. 84, by the way, 84.34 is my magic number for overbought on Amazon weekly RSI, and there's our negative divergence right there. So from this point to this point, you really should that's what your line would look like. Plus, a breakdown below trend as well. So again, is this possible that we go up? And if we do, it's going to be months, and this is why. Unfortunately, in trading, the best sell signals, the strongest case you can make to be long or short a stock, sometimes just doesn't work. All market conditions are different. That's why you don't become married to a short position on Amazon if you are going to do this. But if it does continue to play out, so you set your stops wherever they are appropriate and commensurate with your price targets. If you're targeting a move down to this trend line, measure it out in percentage terms, calculate it, and then place your stop. And if that stop, if it's a big move you're going for, let's say you're going for a 30% drop in Amazon and you're allowing a 10% stop loss, do the math. What is that going to mean to you if stopped out? How much money are you going to lose on your position? Well, that's where the position size calculator I created comes in handy. On the top of the site, you'll see an icon for a little calculator. Click on that, and it'll type in how much, what share price you're going to buy or sell in the position, how many shares, what your price target is. It'll do everything for you, and it'll put in dollar terms how much you're going to make or lose if your target's hit. Yeah, I think that's where a lot of people fall shy. They only see dollar signs on what their price target and profit potential is. Then when the trade goes against them, they didn't realize, oh gosh, this is what it feels like to lose, $1,000, $10,000, whatever it is. Okay, Microsoft, Mr. Softy, same thing. There's magic number down here. Is at about 79.68, give or take. And as you can see, going back, I'm just going back a few years here. There's our divergence. We hit the, line there. We had a correction number one. They're equal. They were both about 21% drop. We went on to make an equal high with the indicators going down. So that's divergent high 1, divergent high 2, another 21% drop. That one we didn't hit the purple line. We had a correction, but we didn't hit the purple line. Here we hit the purple line right there. We stayed persistently overbought and then started diverging to this point, 19% drop. And here we are again. So wash, rinse, repeat. History doesn't always repeat itself, but it often rhymes. And these are the things you look at for, double-digit corrections in Microsoft. And we can go down the line and look at the others. Facebook too, see what's happened there. I didn't put an extreme line in. Here's what you have to do. Just grab a line. Facebook doesn't have a lot of trading history. It came public back here in 2012, so really not one that we can't go back a decade or more like the others. Alphabet you can. I don't have a line right now for the extreme line. And you can also see early on, Alphabet came public back in 2004, and that's of course the parent company for Google. And back then, and that's why I don't have a line here, it was companies that come out as IPOs like that Snowflake today. They're typically much faster growth rate early on, and you can see these overbought conditions can become very extreme. So it takes a while. Google's more of a mature company now, or Alphabet. That's where I'd put the line. I'd kind of ignore those, and that's where we hit it there. We hit it there and there. There's our divergence here and here, here and here. Those are your divergence, and I don't have the corrections measured out, but you get the point. Okay, so that's it. That's what I wanted to share today. I wanted to talk again about the put to call ratio, which that's already happened. I talked about that leading up to before the correction. It coincided well with the sell signal. Those clusters of reading came just before this. And again, things like that, not only that, but things like that and everything I just spent talking about on the weekly charts go into my analysis as to how far this might go. And this 11% drop, although by far the biggest correction we've had in months in the Nasdaq 100, tells me based on past history that we very likely may go on to hit this fifth target. It's just a matter of do we go up a little more or not. I'm leaning towards the not scenario. Look, this was a buy signal, it was bullish, puts the near-term technicals on bullish unless it fails. But what happens usually when those tops come, it tends to trap longs, and the dynamics have changed. The momentum trade, like I said, has been pricked. I wouldn't call it an all-out bubble bust, but it's been certainly pricked with this 11% drop. And I wanted to show you one more thing. I told you I was done and I lied. Go back to the FAAMGs real quick and look at the 60-minute charts. I pointed this out the other day. The bounce in these market leaders, they took this market to where we are. They almost single-handedly, Apple, Facebook, Amazon, Microsoft, dragged this market up. Until recently, then you started having some others fire later in the rally, like Tesla and Nvidia and stuff like that. But again, they don't move the needle because of their weighting. So it was the big FAAMGs. And I just want to point out, which I did the other day, the technical posture. These are 60-minute charts, but Apple, here's our primary trend line. We're dancing on it. We hit it there, never looked back until right here. Tested it again, strong rally again. We hit it here, but we're already back down to it. And more importantly, a couple things here. We put in the positive divergence, like I mentioned earlier in the video, and not just the indexes, all these things. This is not usually, and I've told you this before, normally in a bull trend, this is where I want to go long. I want to cover shorts and go long for the next trend trade up to the next move to new highs. That still could happen, but so far this is an anemic bounce off trendline support plus 60-minute bullish divergence. We haven't had that positive divergence for a while, a long time on the Apple 60-minute chart. And we didn't even make it to actually, since we bottomed here, it's almost a double bottom like QQQ. This one was slightly lower, and we haven't even made it to the 38.2 fib right there, the minimum, what I consider usual minimum retracement. So very anemic bounce, relatively speaking, in Apple. I don't care what the percentage terms is. I'm talking about retracement, and they're not coming in and buying Apple like they were for months now. And again, why is that a concern? I can make money in Tesla. I can make money in Snowflake. No. When the market leaders roll over, if they roll over, so far it's just underperformance. And sometimes that'll happen Smaller, lower quality stocks will play a game of catch up, and then these guys will take off. But you'll want to watch this trend line. You'll want to watch these recent lows. It's everything I've been saying on QQQ and NQ. So if Apple breaks its recent lows, it's going to take out trend line support. It's going to mean these divergences did not pan out for what they would have, suggested. Trend line PPO indicator is also in clearly in bearish territory and back testing from below. So if Apple rolls over here, you're going to have a rejection of the PPO signal line off that zero line right there. There was a whipsaw there. Like I said, nothing's perfect, but other than that, look how well it's done staying above the zero line, telling you the trend was bullish. So those are things I'm watching for. Amazon, same thing, a very anemic bounce so far. I have it below the trend line on the 60-minute chart. I have the PPO solidly into bearish territory right now, not even up to the zero line yet. We had, like Apple, positive divergence, which should have, so far really, triggered the next leg up. Maybe that comes. Maybe it wants to make an additional divergent low. Anything's possible. And I'm not trying to be wishy-washy here. These are the things I'll watch for. We get that, and then the stock starts to take off. Maybe it undercuts, because I can tell you that would be a nice little fake out move to break the recent lows. I've been harping on the recent lows, but I did throw out a little caveat that if we slightly and briefly undercut them and then turn around and reverse and regain those levels, and you put in a divergent low, then that would also prove to be quite bullish. So like I said, if that happens, it'll be a sell signal. I'll take it on face value if it comes. But if we recover, especially pretty impulsively, then that could be quite bullish. That could be what we call a bear trap. Break of the recent lows again on Nasdaq 100 futures, QQQ, and all these big FAANG stocks. However, if they just peter out here, and so far this bounce has fizzled out, and they do this is where Amazon's going minimum down here to 291.60. And then I'll have to sharpen my pencil on additional targets. Microsoft here, right there. Bullish divergence. Look at the PPO is right at the zero line, back testing from below. And again, a pretty weak bounce. I don't have the fibs up, but you can look at these. You can just eyeball this and see that the retracement has been pretty anemic so far. We're well below the 38.2 Fibonacci retracement line right here. So that's what I'm looking at. I'm seeing a market that we do have some buy signals recently on the Qs. So near term, that very near term outlook that put that bullish, especially earlier on Monday when we gapped above it. However, they're not buying the market leaders right now. So maybe they start too soon, maybe not. Watch these lows as of now. Yeah, they are not confirming with conviction this bounce. We'll wrap it up here and get this out to you. This has been Randy Finney with Right Side of the Chart. Have a great day.